Hycroft mining is having one of the most spectacular takeoffs so far this year, and lots of people are wondering if the stock will be able to maintain its course and what should be the trading strategy. And this is precisely what we're going to talk about today. In this video, we're going to talk about Hycroft Mining Holding, trading under the ticker symbol HYMC. Right now, the financial market is very volatile, and we got to be careful about which stocks to pick and the exposure and timing of our positions. This video will cover the recent price actions, the technical aspects, and the trading strategy that I would recommend for HYMC. Before the video begins, a quick heads up that my analysis is based on sessions already completed, and that it may not take into consideration the latest events when you're watching it. If that is the case, I will make follow-up videos to reflect them if needed. With that being said, let's jump into it. During the most recent trading session, the stock increased to $1.44 before closing the trading day at $1.32. We should pay attention to the $1.21 level nearby because it was tested as a support level that holds up very well in the recent past. So I believe that it's going to stay as a very good support level for the upcoming trading sessions as well. Over the past 30 days, the trend of the stock has been bullish because the market is now caught up with the potentials behind the fundamentals of a large gold mine first and the short squeeze dynamic that has been developing for some time. From the perspective of a longer time frame, which is 6 months and above, the trend of the stock has been bullish, although the price fluctuations of the stock, let's be honest, has been on the volatile side of things. I think that we're going to see a period of time that's going to be lasting for at least 1 or 2 weeks where the stock has to decide where it's going to go. Is it going to keep increasing upward or is it going to retracing downward? When we look at the price trend overall, it's been bullish at first and now it's holding its place near the $1.25 and the $1.35 levels. Given the current demand on the stock, I believe that it's going to probably be able to hold there for the foreseeable future. The trading volume of Hycroft Mining Holding Corp has been 80 million shares, with an average volume of 85 million shares. Over the previous 52-week period, the price fluctuated between 28 cents and $5. The market cap of Hycroft Mining is currently at $80 million, compared to the enterprise value of $229 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst market participants, the assets value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it means 4 times a year plus 1 annual. It's far less reactive than the market cap and often more lenient as well. One key element to note regarding the enterprise value is that for many growth type companies, one of the most significant assets they own is called goodwill. Goodwill is an expectation of the market that the company can generate more profit and grow faster than its rivals, because the assumption is it has a better management team, a stronger brand recognition, and a bigger online following. It's what makes it unique compared to the competitors. In other words, it's not a tangible asset that companies may use, but it's often the reason why some companies may be perceived to be trading at a discount, as the market cap is lower than the enterprise value and also less reactive than the market cap in very volatile situations. If the company goes to liquidation, the goodwill is gone, and we will be left scraping the bottom of the barrel along with the debt holders for a number of assets that's going to be far less than whatever we see on the balance sheet right now. As we compare the current price to the historical price fluctuations, the stock is currently 365% higher than the 1-month low, 365% higher than the 3-month low, and 365% higher than the 52-week low. On the options market, which gives us a hint about the market sentiment of where the stock price is likely going to head next, The implied volatility is 251%, compared to a historical volatility of 446%. The put-call volume ratio is currently at 0.07. It's normal for most stocks to also tend to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 11,000 contracts a day, versus the 30-day average of 18,000. Regarding the open interest, the most recent volume of open interest is 93,000 contracts versus the 30-day average of 35,000 contracts. For the shareholder structure, institutional shareholders own about 60% of the outstanding shares. The biggest shareholders include White Box Advisors, Nomura Holdings, and Vanguard. It's relevant to understand the shareholder composition of a company because it can help us to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this can be a sign that the stock lacks the depth to justify long-term trust from shareholders. And typically, the consensus is between 25 to 30% of institutional participation for the stock to be considered as an investment and not just a trade. This is obviously subject to a lot of exceptions since many great companies are mostly held by retail investors. But that tends to be the exception and not the rule so far. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, this can be a sign that there is an organized shorting operation going on, such as what is going on with GameStop and AMC. The current short interest is about 30% of the total volume, and nearly 43% of it are coming outside of the exchanges. Overall, my opinion on Hycroft mining is bullish, because the stock is having enough demand for an ascending trend, and the overall environment is now more favorable for the stocks that are relatively more speculative by nature. So the maximum exposure I would recommend is between 1 to 3% of your portfolio, and for the immediate term, my recommendation is to buy the stock, considering the recent price actions and the promising price levels that are close to where the stock is right now. I would recommend to separate the allocation in batches of 10% at a time, so you may have enough room for later purchases as well. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.